Major averages coming off their first negative week in the last 10. And joining us right now to talk about why the rally stalled is Jeremy Siegel. He's professor emeritus of finance at University of Pennsylvania's Wharton School of Business. Professor Siegel, what do you think is the first week of this year a precursor of what to expect the rest of the year?
No, not necessarily. I mean, remember the huge run-up at the end of last year, a little bit of profit taking. You don't want to take your capital gains in December to pay in 2023, rather take them in 2024. I'm still bullish here in 2024. I don't think we're going to have the rise that we had in 2023, but I don't think there's as much difference. A lot of people are talking about the difference between Fed funds futures and what the dot plot is. Wall Street has all these calculations from the Fed funds futures, thinking that those are the expectations of the market. Well, we in finance know that actually they are downward biased numbers. In other words, it looks like there are 6 cuts. By the way, as a result of the rise in interest rates, there's now 5.5 cuts built in. But about 1.5 of those cuts is really what's called risk hedging. And that is you want to buy those contracts. If something terrible happens, geopolitical risk, pandemic, financial collapse, they will go way up. So they offset the risk on other assets. So as a result, people buy them. I estimate that there's really only about 4 cuts that are built in to the Fed funds futures. And we know the dot plot said 3. So really there isn't that much of a difference between the two right now. And secondly, and this is important, it's not so much we need those cuts. It's that Powell said, if there's going to be some slowdown, I'm ready to cut. That willingness to cut is more important than having the cuts. And I think that, we're not going to be as stubborn on the way down as we were in retrospect on the way up. And I think that that's the flexibility. Honestly, I would love the economy to keep on chugging along. And for them, if it chugs along at 5% Fed funds, that's not bad for stocks. So I think I think those two things, if you combine them, not much of a difference, not all that bad about if we don't have cuts in March or May. I think that profits are going to be good in 2024.
That is a very rational approach, because I keep getting the feeling that people think, rate cuts are a great thing that's going to save us. But if the Fed's cutting rates, it means the economy is dropping, and maybe that negates the whole thing. Your idea that it doesn't matter if you get rate cuts or not, because if we don't get rate cuts, it means the economy is really strong. That makes a ton of sense. Why don't more people talk about that?
Well, I think that's one reason why I don't think the market is, it's as worried about it as others about when they will cut. I mean, another thing that is bad is that they don't cut rate because inflation flares up again. I don't see any sign of that. And by the way, I do think they're going to cut rates because I think inflation is really going to slow down. And that's a real positive for the market going forward. So I think that they should actually cut rates, because slowdown of inflation with the same rate does pinch the economy more. That's been brought up by, all of you and Wall Street also. So I think we are going to have rate cuts, but one has to realize big rate cuts might mean a real slowdown and recession. Well, the stock market doesn't want that. So I don't think we should get as hung up about exactly the pace of rate cuts as so many people are in looking at the market in 2024.
In terms of what you expect from maybe just CPI, if you think inflation is not going up, we've got CPI read later this week. If it's hotter than anticipated, will that cause you to change your mind, or do you think you wouldn't look at any one number and read too much into it?
And truthfully, for instance, people were worried about that wage increase that we saw on Friday. And one has to remember there's a big wedge between wages and inflation. That's called productivity. And productivity has been fantastic. Last year, 2.5%. That was the most in many, many years, excluding the pandemic year. And what that means, if we have 4.1% wages and a 2.5% productivity growth, that's under 2% inflation. So I was not worried about that wage. You're right. We're going to have CPI and PPI at the end of the year. Remember, the Fed and the BLS still doesn't get shelter right. We've talked about that so many times. So you have to take out an awful lot of things. But take a look at the sensitive commodity markets. Now, oil's gone up a bit because of the Red Sea, but outside of that, we see nothing really going up. And it's those sensitive markets that are early indicators, in my opinion, of inflation. And so that's why I remain calm about that.